So good morning, ladies and gentlemen. We're just trying to summon in the people to come. Please bring your breakfast in from outside and sit down at one of these tables here. They're still quite empty in the front, so don't be shy about coming in and taking part from the front. So my name is David Marsh from OMFIF. I'm the chairman of OMFIF, and it's my great pleasure to welcome you here once again for the launch of the index that we do every year. And we've been doing this now since 2017 with our friends at Absa. I mean, it's been a wonderful tradition that we started off, I have to say, and I can say this within these four walls, it started off over a few glasses of red wine in a bar in Cape Town in 2016 or maybe even 2015. The idea of doing a scorecard done in a neutral way, but informed by a bit of science on how well our African capital markets developing. And to paraphrase something that a well-known German economic minister once said, capital markets are not everything, but without capital markets, everything is nothing. I do believe capital markets do make a difference. And I was very pleased last night at the excellent reception and dinner that Absa hosted in the African Museum of Contemporary Art, to be told that over the last 10 years or so, the proportion of business that Absa has done on these African capital markets, the integrating African capital markets, has risen quite substantially. And I think this is a huge contribution to the resilience of Africa. Now, I'm not going to go into the details about the capital market index, because all that will be done in a few minutes. Clever from the United Nations Economic Commission for Africa will make a keynote address in about 3 or 4 minutes. And I would like to say how pleased we are to work with you and your people. I mean, there's been a number of very, very substantial gatherings and meetings by telephone and by video and so on. Thank you for all your help that you and your staff have given us on this. Jeff Cable from Absa is here. Charles, who's the chief executive, is here. You know, without all this wonderful collaboration with you and your people, which has been quite seamless over the years, this wouldn't have come about. And we've had different teams working on it. I think I'm the only person still around who kicked this thing off in 2016, 2017. We've had different teams of people, but as our friends from Absa were saying last night, they have formed a seamless unit with Jeff. And of course, you are also another pillar of continuity. And now you've got a beard, you look even younger, I have to say, Jeff. So that's a very good way of bringing together the continuity also with Nikhil, who from our side, Nikhil Sagani, who's the head of our economic and monetary policy group, but also it doubles up as head of research. The two of you have been working together extremely well. I just want to say a few words about Africa before we get going, and that is really to say that Africa is still punching well below its weight, and that's been a truism for many years. The financial side is just one part of it. Africa has been clearly vulnerable to the various shocks we've had in the world economy. The war that's going on now, the two wars in Middle East and in Ukraine, Russia, a place where Africa doesn't take sides, but Africa is clearly affected by those two things in a negative way. Africa has done incredibly well to get through all the shocks, I think, over the last 10 years. And to use that well-worn phrase, resilience, that has really shone. And the fact that you do have now a more integrated African market, and particularly more African capital market, I think has helped resilience. There's a few things I think Africa could do more. One is on the whole critical minerals side, where there has to be, I think, a deeper analysis of how Africa can contribute to the greening of the world. And you must not allow other countries, whether in Asia or in the United States or in Europe, to exploit you. I think Africa has to go into the open space on critical raw materials. Discussed that a little bit last night with various people. There must be ways, maybe through the United Nations Economic Commission for Europe, that Africa can somehow take the lead somewhat more in the analysis of this whole setup. The other question regards central banking, which is, after all, a core theme for OMFIF. I do believe that there would be room in coming years for a kind of African bank for international settlements, whereby you could pool resources, not just in areas like reserve management and financial market transactions and so on, but also in approaching big subjects like artificial intelligence and how to marry the undoubted scientific expertise in Africa, in African universities, in African banks, in African research centres, marry that to the good of the financial markets and capital markets in particular. So there's just a few ideas very early in the morning. It's been wonderful that you can come out at such an early time. This glorious red that we have here, I do congratulate Absa on putting the red together. And I just so happens I've got a red tie on. It's got nothing to do with the fact that this room is decked out. But I now feel part of the Absa family with this tie, you see, which I bought in a shop in Florence, not knowing that it would just fit in so well into this ambiance. So thank you all very much for coming. Let's have a real dialogue with the audience as well. Let's have some real energy in the room. And I'm going to hand over to Claudia now from the United Nations Economic Commission for Europe to say a few words to set us on our way. So over to you.
Yeah, thank you very much, really, for this opportunity. And thank you very much, colleagues. I was expecting very few people, because waking up at 7 is always difficult unless you are chasing money. And now I see that this is really the right way to go. And thank you so much. I wanted just to say that before I start, from the African continent, we are facing big challenges. We are facing big challenges, and we've been hustling in terms of how to reform the international financial architecture. And when we had a meeting in Victoria Falls earlier this year, in March, the ministers of finance on the continent really challenged us. They were having issues of climate, which is really affecting almost every country. They were having issues of finance. Getting concessional resources have been very, very difficult. And as the countries have grown, the financial institutions, especially the one providing concessional resources, have really not been forthcoming at the same rate. The issues of debt has hampered many countries' growth and investment. The fiscal space has been shrinking. They were facing many other issues that have been discussed over time. But for any kind of sustainable development can only be done with the participation and leadership of the private sector. Government alone cannot develop our continent. And in many areas that you mentioned, now with the Africa Continental Free Trade Area, where we need industries, we need regional value chains, we can no longer concentrate on one country, where we need to build infrastructure that is needed for the future. We need private sector. We need our financial institutions to participate. And that's why this work that you are doing is quite important. Capital markets usually provides long-term resources that is going to help, that helps the private sector to really this time invest looking long-term. So now it is an honor to welcome you all today to the launch of the Absa Africa Financial Markets Index 2024, organized in collaboration with the Official Monetary and Financial Institutions Forum, MFIF. Is that how you call it, MFIF? I wish to extend my appreciation to the organizers and to all of you for your commitment to this crucial discussion. With Africa's sovereign debt reaching over 1 trillion and with more than 1 in 3 countries in or at risk of debt distress, African countries face persistent and emerging challenges in maintaining financial stability and mobilizing the crucial financial resources required for sustainable development. The rapid rise in the external debt continues to place considerable strain on many of our economies. The ability of African nations to issue sovereign bonds on international markets has also been severely constrained, and this is driving governments to rely increasingly on domestic credit markets to finance budget deficits. In response to these challenges, several African countries have undertaken major foreign exchange reforms aimed at stabilizing their economies. Ethiopia, for instance, has introduced a more flexible exchange rate system to boost export competitiveness, address persistent foreign exchange shortages, and attract foreign direct investments. These reforms are part of a broader strategy towards transitioning from a state-led economy to a more market-oriented one. Colleagues, a well-functioning financial market channels resources to where they are most needed and is a powerful driver for economic prosperity. Strengthening local capital markets and diversifying the investor base will not only help governments mobilize more funding for economic recovery and building back better, but will also build financial resilience to future shocks. The development of robust financial markets is therefore integral to our efforts to mobilize domestic resources and drive Africa's recovery and sustainable development. However, this requires substantial capacity building, robust infrastructure, and the development of reference tools and benchmarks. It also requires peer learning mechanisms to help identify gaps and set priorities for financial market development. To this end, the Absa Africa Financial Markets Index has become an indispensable tool for policymakers, offering insights into the development of financial markets across 29 African countries. The index evaluates financial markets across 6 pillars. As you all know, market depth, access to foreign exchange, market transparency, tax and regulatory environment, capacity of local investors, macroeconomic environment and transparency, and legal standards and enforceability. This comprehensive assessment enables governments and financial institutions to make informed policy decisions and drive forward their financial market development agendas. As Africa's financial landscape evolves, so too does the index. This year, it reflects new and emerging trends, including financial technology and the growing importance of environmental, social, and governance policies. The proportion of FMI countries implementing ESG initiatives has increased to 71% from 57% in 2021. This helps to attract new investments as sustainability becomes a key focus for global investors. Notably, we have seen the listing of the ESG bonds in 2024 in Botswana, Cape Verde, Mauritius, and Zambia. Furthermore, Rwanda and Zambia have implemented new climate-related financial regulations, setting an example for the continent. As part of the mandate to foster domestic resource mobilization, the ECA has been assisting member states to develop their local financial markets, including local currency bond markets, while investing special efforts in inclusive and sustainable finance. This event, supported by ECA, offers a valuable platform to present the 2024 edition of the index, exchange market updates, and delve into the technical aspects of data sources and methodologies. It is also an opportunity to engage in meaningful discussions with stakeholders on the key issues that shape continent's financial market landscape. I'm confident that this event will provide the participants with a deep understanding of the index's insights and stimulate fruitful exchanges of ideas on how we can collectively strengthen Africa's financial market. Once again, I welcome you all to this launch and wish you insightful and productive deliberations. Thank you so much.
Good morning, all, and let me just add my thanks to the thanks you've heard earlier for everyone getting up just a little bit earlier and realize it wasn't just the blackout curtains. It is, in fact, still dark when you go out on the street. But on the plus side, you can imagine what you've already accomplished when you see that it's only 9 in the morning and your day is going to be very fruitful. My name is Jeff Gable. I'm lucky enough to be the chief economist of Absa and been involved in this project, thinking about how to sort of help generate the discussions that will push Africa's financial market development forward. Been involved with this really since 2016 as we were putting together the first ideas about what an index might look like. And I can only say that if we knew at that point it would turn into the sorts of discussions and panels and engagement that we're going to have today, I can't tell you how proud we would be then and how proud we are now. So I guess the first bit of this is that for those of you who've been here before, you'll know that our financial market index is not about where the highest returns are going to be. So for the people in the audience that were, that pen can kind of go down. We're talking about the development of those financial markets. We want countries to be in the best position, right, to be able to attract capital first and foremost. And whilst we're having this discussion here in DC, there's a natural element that will think about bringing foreign capital onto the continent, and that's an absolutely critical component of this discussion. But it's also about putting in place the right financial market ecosystems so that we can mobilize the money that's in the continent, get it out from under the mattresses and working, or money that's out from the mattress already but looking to go overseas for opportunities to ensure that it finds a productive use on the continent. And the way we think about this in terms of the index itself is that our editorial angle here is that markets that are open, that are transparent, and that are accessible is going to be the right kind of way to do that. And that was very important when we started this discussion back in 2016 and 2017. But as we've heard from our peers at the European Commission for, not the European Commission, sorry, the Economic Commission for Africa, the environment has been very tricky, right? And so whether we think about the levels of debt, whether we think about sort of global risk-on, risk-off environment, whether we think about COVID and the scarring, economic scarring that's generated, having a financial market ecosystem in place that makes it as easy as possible and as frictionless as possible to put money to work in Africa has never been more important than it is now. And so this product is here to facilitate discussion and is to facilitate debate and learning amongst policy and makers and regulators, the users of capital, the providers of capital. It's really the mix of people that are in this room right now. And so we launch here today on the sidelines of the annual meetings. We'll launch in London next week, and then we'll be going across the continent. We've got sort of a half dozen countries in the next few weeks where we're going and sitting down and generating those discussions on the ground. We have, in the way that we measure this, and the details are in the very back pages of the beautiful document that you have in front of you, but there's kind of more than 40 indicators that we measure in this space. Some of them are still a bit subjective. The vast majority of them are very quantitative and very objective in that space. We're up to 29 countries this year. We started with 17, and we really must thank our partners in this at the Economic Commission for Africa for helping us each and every year to boost the number of countries further from where we are before. And then the scoring, and there's a touch upon this also in those back pages, the scoring is relative, right? So the country that's doing best in our index will score very highly on any particular measure, and then we sort of rate down from that. To help us focus around this, I mean, what does open and transparent and accessible mean? If we started this discussion with a survey and asked people to put in their top 5 things, we would probably end up with quite a list. And I say that out loud, it's probably not a terrible idea when we think about developing the index going forward. But we've sort of organized ourselves around 6 in the document. We call them pillars. You can think about them as themes. We're thinking broadly in the first of our pillars or chapters here. It's about the depth of markets. That's the types of products that exist, the amount of trade that flows through them and the frictions that are there. The second of our broad themes is around foreign exchange. And that's not just about, is enough of it available, but it's also about that transparency and openness. Does the price that you see on a screen or that you receive from the central bank reflect what you can actually transact at? Is there enough a sort of movement in the system to allow normal trade to take place? The third of our broad themes is around market transparency. It's around sort of tax and tax regulation. Again, our editorial here is that we want markets to be open and accessible and transparent, so higher withholding taxes score less well in our space, as an example. It's around transparency in that space for that things like sovereign credit ratings, things like corporate credit ratings, right? Really encouraging as much light to be shone into the corners of these countries as possible. The fourth pillar, and we've renamed it a little bit, but the purpose of the pillar is exactly the same for this year. It's thinking about local pension fund development. The idea there is that you want sort of long-term capital in country to help boost the long-term economic prospects of those countries. And we'll hear a little bit later, it's one of the areas where, from a small number of countries, we've had some of the most exciting developments, but it's also fair to say that for the majority of countries, they're very early on in their process towards developing long-term local capital. The fifth chapter is around macroeconomics and macroeconomic transparency. So on the economic side, it's things like countries that are growing faster, that have lower inflation, that have lower levels of debt. But the transparency is just as important for us. So do you have clarity on when budgets will be announced, when interest rates or when monetary policy is a focus there? Simple things. Do you know when the meetings are taking place? When the meeting's over, do you know what they discussed and what they decided? It sounds in many cases like a very low bar, right? But what we see is it's not universal across the continent where that kind of transparency is being delivered. And then the last of our pillars is around sort of legal standards and enforceability. So there we're thinking about the adoption of various global standards in this space. We're thinking about netting off of collateral and others. But all of these things are designed to create a financial market ecosystem that has less friction in it, that's more open and transparent and accessible. And beyond just the things that we measure explicitly or that you see in kind of the pillars in front of you, the real wealth of the document or the real strength of it is the inputs in there that we get from all the various contributors. So you see lots of quotes where people are providing color on the environment and not just the hard numbers that exist, but also we take a look at a number of kind of special topics, things that feel to us are really important to this discussion, but we might not have in the formal scoring yet. So for example, one of the things that we get asked about an awful lot as we have this discussion around financial market development is the ability of African countries to really tap into retail investors, right? Again, it's getting that money out of the mattress and into something fruitful, right? Providing returns for those people who have struggled so hard to save what could be very modest amounts, but to provide local capital into local businesses to allow them to finance themselves at better rates. And so one of the things that you'll see here in the back kind of third of the fourth pillar or chapter in the report is some really interesting stuff being done across the continent, bringing retail investors in. So whether it be in West Africa, in the pulling together of a number of securities, a number of countries into a securities exchange, allowing retail investors to access all of them, whether it be the DAO system in Kenya that looks for sort of app-based, mobile-based access to financial products that's marketed not only at Kenyans in Kenya, but actively marketed to the diaspora, providing an easy way for somebody in Connecticut to put their money to work back in the home country. So lots of exciting things in the document beyond the formal scoring itself. But let me spend a moment and think about that formal scoring, because often, maybe not for always the right reasons, but that tends to be the primary focus here. So our top 3 countries in the index, indeed the top 5 are the same as they were last year. South Africa may not be the most vibrant economy in terms of economic growth, but it has a really developed financial market system and has done for the better part of a century. So it should be no surprise that that tends to be sort of the high water mark in a number of these chapters. So South Africa's come first, again, for all 8 years that we've done the report. Mauritius improving their score yet again this year, a very solid second place. Nigeria holding its third place, followed by Uganda, one of the strongest performers that we've seen, or strongest improvers over the recent years. In Botswana, in Ghana, just outside the top 5. But as you can see in sort of the table in front of you, any country that sat there in green means that their scores are improving. And so if we touched upon already this morning, one of the most exciting things is that in this year's, in this edition of the report, we've seen the highest proportion of countries increase their scores over a year before. We got 23 of the 29 countries having done better now than before. And if we think about it more broadly, and if we think about countries from the time that they entered, also the majority, the lion's share of countries have managed to improve their scores over the time that they're in the index. What's been done since, I guess we met about a year ago? Now we're going to touch into much more detail in a moment, but I just wanted to provide sort of some high-level overview here. We can all squint right now. This is why 8K matters when we move technologies. What I want to highlight is that in every country, in all 29 countries we have in the index, not all countries may have seen their scores improve, but the vast majority have. But in every country we look at, we can see evidence that the countries are moving forward in terms of openness, transparency, and accessibility. And so there's a couple broad themes that you'll find in this year's report. Part of it is just the environment that countries find themselves in, from where we were 12 months ago, and certainly from where we were 24 months ago. It's just more positive, right? So in that space, easier global conditions have generated higher market turnover, which helps scores in the first pillar. It's helped boost, for many countries, FX reserves, help scores in the second pillar. It's improved sort of equity valuations. So it's helped pension fund assets in the fourth pillar in that space. For many countries, inflation's a little bit lower than it was before, growth's a little bit higher. So this environment has helped boost scores. But what you see on the table here in front of you, and in the report, it'd be easier to read, it's on pages kind of 10 and 11 of the report. But in the report, you see that away from those improvements that in some sense have been delivered externally, there's active engagement from countries that are looking to improve their lot. So whether it be things like better transparency in the foreign exchange market, really interesting developments there in places like Nigeria, in Egypt, in Ethiopia. Whether it be, as I'd mentioned as an image earlier, shining a light into the corners of finance, having more credit ratings on the corporate side. 15 countries across the continent have more corporate credit ratings now than they did a year earlier. Whether it be transparency on things like the MPC, where Tunisia's made really important strides in that space, or whether it be countries like Ghana in adopting global legal standards. So we're seeing active engagement by countries in this space. And then, as we've touched upon already, the importance of things like ESG. So we mentioned we have 23 out of the 29 countries have adopted full or partial frameworks around ESG, preparing the groundwork for issuance into that space. We've got 16 countries that have issued into one or another parts of the ESG space, and that includes, in the most recent year, the first listing of green bonds in places like Cabo Verde, Mauritius, and Zambia. It's sustainability or sustainability-linked bonds, first ones there from Botswana, Rwanda. The broad message here is that in an active way, countries are working each and every year towards open and transparent and accessible financial markets and financial market development. So I hope that's given you a flavor of what's in the report. I want to hand over to the primary authors of the report, Nicole, to take you through the chapters in a little bit more detail. But thank you very much.
Thank you, Jeff, and I'll be the fourth person to say thank you for joining us this early in the morning. I will be taking you through the scores of each of the 6 pillars. So starting with market depth. So this slide here shows the scores for Pillar 1 out of a maximum of 100. The red bars are the scores for this year, and the dots are the scores for last year. South Africa on the left-hand side scores the maximum of 100, as Jeff just mentioned. It's the largest, most liquid and most advanced financial market on the continent. But more generally, scores increased for 19 countries. And again, as just mentioned, this is partly due to more favorable global financial conditions in the past year or so, which has bolstered the size and liquidity of domestic equity and bond markets across Africa. But perhaps more importantly, there's been some quite significant structural improvements in many cases as well. That's the case in Egypt, for example, which is the biggest riser in Pillar 1, rising by 11 points to a score of 53. There's been the introduction of trading on secondary markets for treasury bills for the first time, which has significantly improved its score for the size of the sovereign bond market as well as its liquidity. There's also been a broader trend, which Jeff has just mentioned, of new products coming to market in Africa in many cases to attract new pools of capital. That's particularly been the case with ESG assets, as well as Islamic financial products. Now you can see there's many countries here on this table where either on domestic exchanges or in OTC, green bonds, other ESG products, or Islamic financial products are available. And there's 4 countries in particular that we've highlighted here, Kenya, Zambia, Botswana, and Rwanda, where there's been the inaugural issuance of one of these assets in the past year. Interestingly, through the surveys that we've run with many organizations across Africa, like central banks and stock exchanges and regulators, many of them mentioned plans to introduce new assets in the next year or two. So that includes, in the case of Uganda, they're looking into Sukuk bonds. In Malawi and Morocco, mentioned plans to launch ETFs in the near future. So this is one to look out for. I think there'll be a lot more assets coming to market soon across Africa. Moving on to Pillar 2, which looks at access to foreign exchange. Here again is a similar chart to what we saw for Pillar 1, showing the overall scores for Pillar 2, with the red bars showing the score for this year and the dots showing the score for last year. Here there's been a bit more of a mixed performance, but again, there's been an increase in scores for more countries than they fell. South Africa once again leads this pillar, although it was one of the 10 countries where scores did decline slightly. That's mainly due to slightly weaker FX reserve adequacy, which we measure in terms of months of imports. Generally, this is one indicator where we did see quite a lot of mixed performance. Some of the more favorable global financial conditions, and in some cases, especially for the commodity importers, the fall in food and fuel prices eased some of the external pressures, and that helped many countries to rebuild their reserves. although there were some significant divergence on that front, and there are some countries, and many countries in fact, which are still struggling with a lack of foreign exchange. There's 6 countries in the index where foreign exchange reserves are less than 3 months of imports, which is the commonly held threshold for reserve adequacy. Again, though, there is some good news on this front. Madagascar, for example, has significantly improved its interbank FX liquidity, and is shown there on the left-hand side. Tanzania, and we'll perhaps hear more very shortly, has issued a new FX code of conduct, which has improved transparency in how they operate in interbank FX markets. And the DRC is one country where there has been a notable improvement in FX reserve adequacy, helped by IMF financing, although it is one of the countries where it's still in a fragile state, and it's still one of the lowest scorers on this measure. Now, one key thing that we look at in the report is how there's been significant reforms to promote international investment, and we have dedicated an In Focus page to look into more detail on that, but I'll just run through some of the developments here quickly. So there's been some pretty significant foreign exchange reforms in Nigeria, Ethiopia, and Egypt in the past year to move to more market-based FX regimes. Now, it's been too early for this to have a meaningful impact into the scores this year, but from the survey respondents from each of those 3 countries have mentioned that there's likely to be improved activity in and access and transparency in FX markets based on these reforms. Zambia, and as just mentioned, Tanzania have adopted or issued new FX guidelines for their domestic markets. And generally speaking, while it has been relatively limited, there has been improved access to international capital markets as well. So it was quite significant that last year there was not a single sub-Saharan African country that tapped into international capital markets. Well, in the first half of this year, there were 4: Benin, Cote d'Ivoire, Kenya, and Senegal. There's also been encouraging news with debt restructuring deals finalized in Ghana and Zambia, and negotiations are underway in Ethiopia, which should hopefully help to bolster their access to international capital in the coming years. And there's been, again, new initiatives that are being undertaken. So diaspora bonds, which Jeff just mentioned in the case of Kenya, but also Cabo Verde, are looking at ways in which they can mobilize savings from their diaspora community into their local markets. Moving on to Pillar 3, which is in many ways the bedrock of the financial market infrastructure, looking at market transparency, tax, and regulatory environments. Again, this is a similar chart to what's shown before about scores this year and last year. Mauritius, South Africa, and Egypt come in the top 3 this year. And again, this is one of the pillars where scores have increased for more countries than they've fallen. And actually, that's the case for all 6 pillars. Again, for the first time this year, that's been a trend we've seen. That's largely due to an improvement in the number of corporate credit ratings by international rating agencies, Moody's, Fitch, and S&P, which we look at as an improved measure of transparency for these markets. So it's not necessarily what credit rating they achieve, but just the fact that they have a rating and it provides more transparency for investors is something that many countries score more points for this year. The biggest rises are Rwanda, Zambia, Senegal, and Cote d'Ivoire. And that's all linked to progress on ESG, which is a measure we adopted in this pillar for the first time in 2021, as sustainability is an increased focus for many investors across the world. And so for African markets to incorporate sustainability into their own financial market infrastructure is seen as a key way of attracting new capital, and that's what these 4 countries have done in the past year. Which begs the question, what did they do? Well, as we've just heard, in the case of Rwanda and Zambia, they've included for the first time new climate stress testing regulations for their domestic financial sector. And this brings the total up to 8 this year. Now, this is significant because when we first introduced this indicator in 2021, there was only 1 country doing this, South Africa. So it shows that there's increased focus on these measures in central banks across the continent now. More generally, 15 countries have incentives for issuing ESG assets, like tax breaks, for example. And in 23 countries, there's now formally implementing ESG into their market frameworks. One new development on that front is that the regulator for West African Economic and Monetary Union, which includes 3 AFME countries, Benin, Senegal, and Cote d'Ivoire, introduced a green taxonomy to classify green, sustainable, and social assets. Moving on to Pillar 4 on pension fund development, which, as we heard earlier, looks to gauge the ability of local institutional investors to support the growth of local capital markets. The primary indicator in this pillar is the size of pension fund assets per capita. And you can see here, just by the shape of the charts, that this is one where there is significant divergence compared to any other pillar. Namibia, for the 5th year in a row, scores the maximum at 100. It has the largest pension assets per capita on the continent at close to $5,000 now. Other countries in Southern Africa also tend to score relatively well. And while scores did edge up for the majority of countries, again linked to some of the more favorable global conditions, which helped to increase the size of pension assets, it remains below $100 per capita in 15 AFME economies. Hence, the average score in this pillar is just 28, whereas the average scores in any other pillar is much, much higher, which suggests there's significant scope for improvement in bolstering the development of pension funds across the continent. Now, there are some new initiatives being taken in certain countries. Well, I say new, in some cases, there have been new regulations that have been introduced over the past 3 to 5 years or so. That's been the case in Botswana, Lesotho, and Namibia. And in all three cases, they've introduced legislation to encourage pension funds to invest more in their domestic markets to support growth there. Now, more generally, and we've just heard from Jeff, although it doesn't explicitly link to the scores, we do look at other measures of bolstering local investor capacity. So 19 countries have or are in the process of introducing mobile-based apps or online access to local financial markets to encourage more retail investment, as Jeff very well put it. Take that money from under the mattress and put it to work locally. And almost all the surveys that we collected when we asked about what countries are doing in terms of financial inclusion initiatives, there are various financial literacy campaigns across the continent to, again, try and mobilize better access for local investors and retail investors into local markets. So again, this is one to watch in future and an encouraging sign of how, or an encouraging route for countries to grow their financial markets. Moving on to Pillar 5 and the macro environment and transparency. Again, this is one where we see scores improving for more countries than they've fallen. This is partly linked to some of the global factors as mentioned before. Inflation is generally falling, growth generally picking up as well, which is bolstering scores in many cases. Botswana, Uganda, and Tanzania are the top 3 in this case. As highlighted here, some of the biggest improvements are in Rwanda, Madagascar, and Ethiopia. These are countries which have seen significant falls in inflation over the past year or so, but there has been some significant divergence. There are some countries which are still struggling with high inflation. That's particularly the case in countries like Malawi, Nigeria, and as highlighted here on the right-hand side, Angola, which has seen a significant increase in inflation over the past 12 months linked to currency weakness, which weighs on their scores. And that's shown more generally in this chart here. So the period we look at, this chart shows the change in headline inflation rates from June 2023 to June 2024, which is the period that we look at for the purposes of the report this year. On the left-hand side, as mentioned before, there's countries like Angola and Nigeria, which has seen a significant increase in inflation, which drags down their scores, and inflation's above 30% in those countries. Whereas on the right-hand side, you can see countries like Ghana, Rwanda, Madagascar, Ethiopia, where there has been a significant fall. And more generally, the median rate of inflation, so just taking the middle country in the AFME report, has fallen to 4.6%, whereas it was 7.9% a year ago. So this again partly matches some of the global trends that we've seen over the past year, but inflation is still running high in many countries, including Ghana. Despite the significant disinflation there, it's still well above target. So there's still a lot of work to be done in some countries to stabilize macroeconomic conditions. And perhaps the biggest concern when it comes to macro factors is on external debt. External debt ratios as a share of GDP has risen in 18 AFME countries in the period that we look at from 2022 to 2023. And more generally, the IMF deems that 18 countries in the index are either in or at risk of debt distress. I suspect we'll come on to this when it comes on to the panel discussion, but This is probably one of the biggest macroeconomic vulnerabilities that many African countries are facing right now. Now, last but not least, Pillar 6 on legal standards and enforceability. Here we look at the existence of netting and collateral legislation, as well as the existence of clean legal opinions from external bodies on the use of standard master agreements, so ISDA, JIMRA, and JIMSLA. Now, similar to Pillar 4, this is one where we see a significant divergence in scores. Mauritius and South Africa remain the only two countries to score the maximum in this pillar of 100. They have the legal frameworks in place to support netting and collateral, and they're the only two countries which have 3 clean legal opinions over their use of standard master agreements on ISDA, JIMRA, and JIMSLA. The only new development in the past year on this front is on Ghana, which received a clean legal opinion from ICMA for its use of JIMRA just a few months ago. And so that nudges up its score to 90 this year from 85 a year ago. And it's one of only 4 countries in the index where there is at least one clean legal opinion by an international body. That said, there are some legal amendments underway in many countries, or planned at least, to support netting provisions and to try and attain a clean legal opinion. So again, this may be one to watch in the future. Now, to wrap up, you've heard a lot from Jeff and I today, but there's 3 main takeaways that we'd like to share here. So the first is that there's been clear and widespread progress across Africa this year. 23 countries in the index have seen their scores improve. And this is the first year where in every single pillar we've seen more countries increase than decrease their scores. Now that's partly due to favorable global financial conditions, which has improved the size of domestic markets and helped to stabilize macro conditions. But that said, we have seen some significant progress on developing market infrastructure. That's particularly been the case on ESG, more broader product diversity, new products coming to market across Africa, and transparency improving in many cases. But of course, there's still work to be done, and there's some key areas of development. That's particularly the case for pension systems, as we saw in Pillar 4, scores are still relatively low for many countries. Enhancing legal frameworks, which again, for Pillar 6, we just saw scores are still relatively low for many countries. And managing external debt, which is in many cases the biggest macro vulnerability for most countries. So that concludes the presentation. Thank you very much for listening. I think you've all heard enough from me now, so we'll be digging deeper into the findings with an esteemed panel of experts who I'd like to welcome on stage now to engage in more detail on each of these topics we've just heard. So we have Yamungu Kayandabila, Deputy Governor from Bank of Tanzania, Michael Atingi-Igo, Deputy Governor of Bank of Uganda, Zafar Parker, Head of Financial Markets at the South African Reserve Bank, Martin Habel, who perhaps has the longest job title I've seen, Head of Treasury Client Solutions for Africa, Europe, Middle East, Central Asia for the International Finance Corporation. I hope I got that right. And Catherine Patillo, the Deputy Director of the IMF's Africa Department. Please, could you give them a round of applause as they make their way on stage? Thank you. Oh, thank you. Thank you all for joining us on the panel. Before I get started with my own questions, we have a video from Anthony Kilroy, the Head of Global Markets, Africa Regional Operations for Absa, who's also been a key part of the research for this project on Absa side alongside Jeff. Unfortunately, he's been unable to join us here in Washington, but We have a quick video from him who will be providing his remarks on the AFME project, and we'll be asking the first question for our panel today. So if we could get the video up on that front, please.
Good morning and good afternoon to you all as you join us from across the globe for the launch of the Africa Financial Markets Index 2024. My name is Anthony Kirui and I head global markets for Absa for all our businesses outside of South Africa. My apologies for not being able to join you in person in Washington, D.C. for this year's launch of the report. Indeed, our annual report and index is something I'm personally passionate about, as we as Absa, in collaboration with our stakeholders, work to deepen financial markets on our continent. The opportunities for countries on our continent, and indeed for policymakers and regulators in partnerships with local market stakeholders, to drive the adoption of legal standards and frameworks that help to support efficiency and transparency within our markets under supportive local laws. In turn, allowing market participants to reduce counterparty risk in the event of insolvency or default, and provide legal clarity that these provisions will be upheld and therefore contribute to enhancing financial stability and ensuring the efficient use of capital as a result, accelerating the growth of transactions in our domestic markets. Over the 8 years that we as Absa, in partnership with MIFID, have been preparing and presenting the Africa Financial Markets Index, it has become clear that regulators and countries covered by the index continue to see the value in driving reforms that will enhance closeout netting and the recognition of financial collateral arrangements under local laws. Under Pillar 6, and as captured in the text of the report, it is abundantly clear that a lot of work is being done in partnership with the IMF, UNECA, and Frontclear. However, it is not lost on any of us as to the challenge in driving legal reforms to deliver local legislation aligned to global financial market standards of transparency and enforceability. We are privileged today to be joined by a distinguished panel of speakers and regulators from across the continent. I'd like to take the opportunity to thank you all for being here today. At Absa, we believe your story matters. The report allows us to share our story and therefore provide the opportunity for continued collaboration and knowledge sharing amongst all stakeholders. As we open our panel discussion today, I'd like to give our panelists the opportunity to tell us their story. And with that, here is my first question to our panelists. What are some of the learnings you can share and hurdles that have been overcome and still need to be overcome in the journey to securing clean legal opinions for both JIMRA and ISDA? Thank you.
Thank you for that. So, yeah, how countries are trying to improve their legal frameworks to support the use of standard master agreements. I wonder if, Michael, I know in the case of Uganda, this has been a key area that you've been looking into. I wonder if you could kick us off with the discussion on that front. Should be on.
All right, very good morning to all of you. Thank you for inviting me to this panel discussion. I think really what has underpinned the improvements in legal standards and enforceability at the global level are the challenges that we've had arising from the tough global financial environment, where the financing conditions have tightened, our capacity to build reserves, maintain stability in the exchange rate have been challenging. So we needed to see how, notwithstanding all this, we still maintain a reasonable level of reserves and stability in the exchange rate. So aside from the policy environment that we pursue significantly in terms of monetary policy, we had to go for some of the standards. So if you take, for example, the GMRA, the GMRA was very useful in our case because we were able to build reserves of about $400 million through cross-currency swaps. And also for fiscal operations, who were able to use again a cross-currency repo to mobilize in excess of 500 million euros. So it was to address the challenges that were arising out of that. And then there was this whole issue of closing the netting out. Initially, the transferability of securities in the market and then the pecking order of the securities was not favorable for promoting trade in the securities in the interbank money markets. But then we had to revise the legislation to ensure that there is a protection, there's a ring fencing of the securities in case of insolvency in the financial system. So we came out with what we called the preferred and the appraised book value regulations, which have supported the ring fencing of the securities and therefore supported market development in that area. But most importantly was to support the swap, the FX swaps. We actually ensured that, given the fact that the swap market has been playing a hedging and a holding ground in a situation where the exchange rate was becoming volatile, rather than the offshore was exiting the market, exiting the country per se, the moment they would see some sense of instability in the exchange rate, they would liquidate some of their shilling securities, go to the swap market and hold on their FX there and begin swapping it with the local currency, still contributing to stability. Then when the conditions improve, they get back to the shilling assets. If the conditions worsen, that's when they exist. But then we've seen that they have not actually exited, but they have taken the swap market as a holding ground in a situation where there is uncertainty regarding exchange rate. So that has kind of like minimized the volatility. And this was possible because we adopted the marketplace adopted some ISDA arrangements which have supported the swap market. And of course, then we had other issues that have supported the FX market. There are rigidities, there are frictions in the FX market. The markets are not that deep. And then if you look at the corporate and the firms, most of them are unhedged, but sometimes they have mismatches in their FX assets and liabilities. And then there's this whole issue of trying to anchor inflation expectations via the exchange rate. So in a situation where you don't have sufficient reserves for intervention, we had to ensure that we put in place sufficient reforms in the FX market supported by some of these global agreements which have promoted the trading in the swaps, promoted the support for the interbank foreign exchange market, interbank foreign and money markets. One of these is the umbrella guarantee facility. To the extent that, and that is run through through TradeClear. Now, what has happened here is that if I am having a position in the money markets or I'm having a position in the foreign exchange market, and because of the pricing changes, in the event that I don't have sufficient resources to make up for the volatility arising out of the pricing changes, this umbrella guarantee facility can put in some resources in the meantime to ensure that you cater for those market valuations without you necessarily looking for resources. So that has enhanced the trading capacity in this market. So if you see, for example, in the financial year ending June 2023, the amount of trade in the FX, in the interbank FX market and the interbank money markets was quite significant. And we believe that with the introduction of this umbrella guarantee facility that was done in June 2024, this is going to further boost this trading and therefore giving confidence to the market.
Yep.
Thank you.
Thank you, Michael. And I know in the case of Tanzania, you're also looking into an umbrella guarantee facility, which perhaps we'll come on to in a second. Catherine, I know, unfortunately, you probably have to leave us in about 15 minutes or so, so I'm keen to get your thoughts now. Moving on the conversation to the macro side, we've just heard from Michael that there's been some difficult external conditions. There's been pressure on foreign exchange reserves, and that's maybe prompted some of the shift to focusing more on local markets. But I wonder how you assess the macroeconomic outlook across Africa, especially given the sort of global environment right now as well, and where you see the main opportunities and challenges.
Thank you so much. Really great to be here and to learn about the Financial Market Index, which I think is something, the objectives of which are very much in line with what we would see as the needs for deepening financial markets and the opportunities that would provide. So I'm going to take this back then to colleagues in the Africa Department in the IMF, where I think it's not as well known as it should be. And just to follow up too on Michael's intervention, to note that a number of the issues that he had been discussing and a number of the areas in the ranking are things that we are engaging with countries on in the context of our dialogue and our programs, and helping countries also with capacity development on making progress on. So we're going to release our regional economic outlook on Friday, and the message will be that the overall macro context for sub-Saharan Africa is still quite difficult, and countries are working to implement what are difficult but much needed, reforms to restore macro stability. And thanks to those efforts, we are seeing quite a bit of improvement in macro imbalances. Inflation is down, fiscal positions are generally improving. Reserves, you mentioned the heterogeneity, but reserves improving, and public debt, after 10 years of continuous rise, is now stabilizing on average, albeit at very high levels. So that's thanks to these important policy efforts. The picture is mixed, so we discuss the ranges of countries then with still quite high macro imbalances. About half of the countries have what we assess to be high macro imbalances. But it does point to improvements in the region's economic health. Now, in their efforts to continue to reduce these imbalances, there are three main hurdles. First, growth overall remains very subdued and uneven. Our projection is that growth on average in sub-Saharan Africa will stay flat this year at 3.6% before an increase to 4.2 next year. There's a big divergence between the resource-intensive countries, which are growing at only half the rate of the more diversified economies. And those levels of growth are clearly nowhere near what's needed to improve living standards, reduce poverty, have convergence back to income levels in the rest of the world. The second major hurdle is what we have termed this big funding squeeze. Still very much continues, that although global financial conditions are improving for sub-Saharan Africa, domestic and external financing conditions continue to be tight. So we've highlighted before, the overall funding squeeze, with aid down, China down, portfolio flows down, the countries out of financial Eurobond markets for some time. And you mentioned the improvements that we have seen, the return to Eurobond markets for 5 countries. Cameroon also, sovereign spreads narrowed. But the yields for those issuers are, of course, much higher than pre-crisis, 9-10% compared to 6-7 previously. So this is very expensive financing, both externally as well as domestically. Of course, domestic debt markets saturated in some countries, real prime lending rates very, very high. And we have a lot of liquidity issues also in countries that we're paying attention to. When you look at things like interest to revenue ratios, right? The fact that countries have these their ratios above 20%, sometimes above 30 or 40%, means we've got big liquidity and we've got big net repayments, debt repayments coming due in the next years. So that's the second hurdle. And the third is that the social and political conditions for reform are getting increasingly difficult in some countries. You've always had this kind of complex interplay of poverty, lack of opportunities, but you've got also in some countries, the perceptions of corruption and lack of transparency, and of course food prices, being very high, so cost of living. So this is making a challenging environment for continuing reform.
Yep, thank you. I suppose one country when it comes to the sort of macro outlook, and probably the only area where South Africa scores relatively weakly is on Pillar 5, given the relatively subdued growth outlook, albeit it is picking up now. And I wonder, Zafar, if you could give us a few words on how optimistic you are about the sort of outlook in South Africa, and in particular what you think it might mean for its sort of financial market performance and activity, given, there's been some significant delistings in the past sort of 5 years or so, and whether you think that's a trend that will continue.
Yeah, I'm not going to really talk much about the macroeconomic outlook, but except to say that it's fairly subdued. The economy needs to grow so that we create jobs, and the story then translates well into the equity market, which we have seen quite a bit of outflow until recently, though. So it's important that the economy grows, that we we implement the proper macroeconomic plans that we had spoken about as a country, and that these are simply implemented. There's some progress being made or has been made around interest reduction. As you know, that had been quite a problem over the last few years. We had some logistical problems with Transnet and so on, but that hopefully is being addressed. So what I'm really trying to say, you need the macroeconomic fundamentals to be implemented, and you need a proper growth story, and that's the only thing that will really convince local investors and foreign investors to invest in South Africa, either through foreign direct investments or through the stock exchange and through our bond markets, because they have confidence that we'll bring down the debt to GDP ratio, and our various sectors in the stock market will grow, and therefore good opportunities for investment.
Yep, thank you. Yamungu, I want to come on to you now. Talking, we've heard a couple of times about some of the funding squeezes and some of the pressures on foreign exchange. One important measure that you've taken this year is a new code of conduct in the FX market about to improve transparency in the interbank market. I wonder if you could give us a few words on the measure you've put through there, but also just how you see this issue about lack of access to foreign exchange and how you're managing that at the central bank.
Yeah, thank you. Thank you for inviting Bank of Tanzania. We know, for the past 2 years, I think things have been tough, but I think we have managed as a country. I remember, I think last year, actually we had to to support the market, because the market had dried up in the FX, especially for oil imports, for example. Yeah, so the bank had to really try to support because oil importers were really finding hard to find FX, and you know, and for the first time in, I would say, more than 20 years, we saw, you know, an official, okay, you call it black market, parallel market, coming in. Yeah, and this was really difficult for us as a central bank, but I think we managed. So far, now we have seen, you know, the interbank foreign exchange market now, you know, revived. You know, we have seen some activities, still not much, but we have seen, you know, now the FX market, you know, coming back. Yes, as you know, and I have to say this, Catherine is here. We have a program with the IMF, ECF program, for 40 months. I think one of the issues, reforms we agreed to do is to, like what you say, to have the FX intervention policy, which we did. I think that was last year, December. Then the code of conduct, which we know we borrowed heavily from the global code, yes, to improve transparency, you know, market, you know, price discovery and everything. Yeah. So all of this, I think the outlook is good. I know some of our issues are structural, you know, because it's hard when you are a net importer. You know, maybe you have twin deficits. You have the fiscal side and then the current account, you know, side, you know, is also difficult to navigate. But really, the outlook, our macro adequacy, I think looks great. I mean, the inflation, my brother here, I think our numbers is us and the Uganda 3 point, you know, and inflation. Yep. Yeah. So I think going forward, with these other things happening, you know, out of our countries, you know, the geopolitics, I think we are otherwise very okay.
Yep.
Thank you.
I think you can see the progress that's been made when two central bankers are on a panel smiling about inflation. That definitely wasn't the case a few years ago. Michael, I want to come to you now, thinking more about the domestic market infrastructure and local markets and bolstering how you at the IFC are looking at this, about how countries in Africa are trying to upgrade their capital market infrastructure and where you maybe see some innovations in this space.
Sure, thank you. Maybe just to start, let me commend the authors of the OMFIF and Absa teams and contributors for this report, which is really, I think, very relevant and a very important piece of research and fills an important gap, as Catherine mentioned, and especially for the conversation it triggers. So thank you. So look, at the IFC for us, we are very passionate about capital market development for many reasons, but especially I think for the topics we've been talking about, the debt distress many countries are facing. I think it's just to emphasize the urgency of developing local capital markets and local currency capital markets, because it's, even if it's not a quick fix, it's the only medium-term solution is to have deeper and better functioning capital markets and providing local currency financing to corporates. So we are very passionate about it. We are an active user of capital markets in different ways. Unfortunately, it's not easy because it's about building an ecosystem where many pieces have to work in tandem together. And you know, enforceability, etc. The question that the panel started with is a good example where it touches on different pieces of legislation, and basically making this work sort of requires many stakeholders to work together. Now, so at IFC, we support capital markets in different ways. So we advise governments and regulators in implementing reforms and sort of putting in place sound regulatory and legal frameworks. We have a capacity building program, actually a number of capacity building programs, which has grown quite considerable with the IFC, with the Milken Institute and Paris Europlus, that has now something like 270 or so alumni, mid-career, and by now quite senior officials in central banks, ministries of finance, regulators, and so around the world. But also we try to support a lot of demonstration transactions directly, and we try to issue our own bonds increasingly in domestic markets as well. In terms of the work with regulators and governments, so we have a flagship program across the World Bank Group that is called JCAP, where we're trying to really integrate, since 2018, sort of have an integrated approach, a number of key markets, where we identify gaps, we sort of run a diagnostic, we agree with the government and regulators the priorities, and then implement those basically in tandem, but then directly link it to creating some demonstration transactions that actually can be replicated. So we try to not just stay in the ivory tower and sort of and work on the frameworks. I mean, we're a little bit behind time, so I can mention a couple of examples, but
if maybe I come back to you, I'm just conscious Catherine will have to go very shortly. If I could just ask you one final question, Catherine, on I guess stepping back and thinking about this is the 8th year of the AFME index, and I sort of wonder where we might be in another 8 years' time or 10 years' time, and where you perhaps see some of the opportunities for Africa, and where you think what you think success would look like for African economies over that period.
Thank you. Big question. Yeah. But I mean, we are so positive on the potential, for the region. And some of the areas that the figures are just so striking are demographics and say critical minerals and the green transition. But when you think about demographics, half the entrants to the global labor force in the next 7 years or so are going to come from Africa. This is presents challenges, but huge opportunities for if you create those jobs and the education and skills. Africa is a leader in digital money and digital finance, and we're doing work with a network of central banks on CBDCs and digital payment. We have a network and a survey that has come out, and we'll have a policy paper. But the potential, I think, for continued technological leadership in digital finance is tremendous. Countries, again, have the vast majority of the critical minerals needed for the global transition. Using those productively, but also building up the value chains then for more processing is really promising. In your financial market area, I am very positive again then about the potential for increased financial inclusion, wider access, more diverse offerings. Again, the digital efforts, mobile and digital banking, fintech, regulatory frameworks, consumer protection, development of capital markets, these emerging finance initiatives that we've been discussing, ESG, green financing, Islamic financing, but green financing to become very much integrated, and there's huge amount of interest. It was interesting that in the 4 countries that you mentioned, 3 of them are involved in resilience and sustainability programs with the IMF. So they are working very much in all of those areas for enhancing green finance and catalyzing green finance. And working again with people on the financial literacy, because people are the basis, and the people in Africa again are creative, entrepreneurial, tech savvy, and there's so much potential we think looking forward.
Very good, very optimistic story there. I think for the rest of the panel, we still have another 10 minutes, but I think Catherine has to go. So if we could just give her a round of applause. Thank you, Catherine, for your insights. Unfortunately, I still have more questions for the rest of you. But I just want to pick up on that point on green financing that Catherine just mentioned. And essentially how in the 3 countries here, Uganda, Tanzania, and South Africa, you're looking at this space. We've seen a lot of countries issuing ESG assets, and just wonder if that's an area where you see potential growth in your own capital market. So maybe Michael, starting with you.
Okay, thanks again. I think this is really a potential area for growth. Right now, we are constrained in that our fixed income market is limited to only government securities. So we are working to broaden the products under the fixed market income, of course, including green bonds, including Sukuk, Panda, diaspora, infrastructure bonds as a basis for that. But specifically talking to ESG, I think what we did as a central bank in our strategic plan for 2022 to 2027, we had one strategic initiative of institutionalizing ESG in the entire financial sector. And without preaching to the regulatory institutions, the central bank had to take a lead. We want to become a sustainable central bank. And as a result, we have registered with the European Organization for Sustainability Development, where we're trying to get sustainability standard certification from them. So we began work in ensuring that we become a sustainable central bank. Yep. But importantly, we have also institutionalized the ESG framework across the entire financial sector. Now, this one is going to come up with some KPIs, and certainly we believe that issues like the green bonds are going to be introduced. Green financing is going to be introduced through the intermediation of these supervised financial institutions in the entire economy. And we've had so many training sessions on the issuance of green bonds, and we think we are going to move in there.
Very good. Zafar, I mean, South Africa is obviously a country where there's obviously been some movement on that front, and there's already green bonds available. Is that an area where you see scope for further growth, or any other potential innovations in financial markets?
Yeah, certainly a potential for further growth in the ESG space. But at the bank, we keep on thinking of what the central bank's role could be in further developing this. And certainly, you can't create, you have to spur the development of this space, and so not only within South Africa but within the SADC group, the Southern African Development Community, we have been talking to each other about how we can incentivize investors and issuers to actually incorporate ESG into their financing. So, I'm hopeful that over the next couple of years, well, not too many years, that we incorporate ESG principles in some of our debt issuance. There's quite intense debate within each of the jurisdictions on whether it should be private sector led or whether it should be, led by, say, by the government. So instead of issuing ordinarily plain vanilla bonds or floating rate notes and so on, treasury bills, whether those should not incorporate some sense of ESG. So specific bonds issued by governments that are totally green bonds, might be a way to help increase the momentum or start the incentive for the private sector in each of these jurisdictions to issue green bonds.
Yep, very good. And Yamungu, a similar question to you. And actually, in Tanzania's case, it seems like in the past year, Sukuk bonds has been a big focus as well. Maybe a comment on that, or other innovations that you see as potential drivers of growth in financial markets in Tanzania.
Yeah, no, thank you very much. Actually, I was surprised because I think, our two major banks, CRDB and NMB, they issued green bonds, and I was expecting to see them here.
Oh, apologies. We'll make sure that's there next time.
So, as others, have just shared, actually, in terms of ESG, our counterparts, of course, the Capital Markets and Securities Authority have now issued, of course, guidelines. But this is for corporate and subnational sustainability bonds, and now we are trying also to work on guidelines for sovereign green bonds. So I think we see interest in this. So as I said, our national microfinance bank, did issue sustainability bond. They call it Jamii bond, and actually this one is cross-listed on Luxembourg Stock Exchange. Yeah, and our utility, we have a municipal COSTO in Tanga. Is a subnational, has also issued a brew bond, water, which, has been also, listed at, on Luxembourg Stock Exchange. And as I said, CRDB also, they have also done the same thing. So we see appetite, but as Michael said, I think the issues we need to do in terms of capacity, building awareness, all this, yeah. So it's work in progress, but we see, appetite. In terms of Sukuk, I mean, I think we are now leading in the region. Maybe I don't know Kenya, but I think we are now moving very fast in that space.
Very good.
Yeah.
And Martin, on your side, what examples of innovations that you're seeing in capital markets in Africa as well?
Sure, thank you. So actually the issuances that Yamungu mentioned in Tanzania, for example, are examples that IFC supported. We were very happy to do that. Another example, just to quickly mention, that we supported a year or so ago, which is a good example of what capital markets can do. It was in Cote d'Ivoire, a quite unique first-time electrification receivable securitization, where we worked with the government of Cote d'Ivoire to help electrify 800,000 low-income households and basically securitize the repayments of the cost for meters and wiring, etc. Roughly $250 or so per household over a longer period of time linked to their electricity use. So, and that's was quite a celebrated transaction that we're trying to replicate, and it was offered to the local market, and a number of investors subscribed. That's and sort of speaks to the narrative of basically crowding in private capital into something that normally, typically, governments would have had to fund. So there's a long list of these. So we believe that these type of transactions, I think, are important for other issuers to come forward. Let me just say, Nikhil, maybe that I think one thing that I think is mentioned in the report, but I feel maybe not emphasized sufficiently, is the lack of corporate issuers. So one theme we definitely see across Africa is that in most markets, corporate issuers are almost absent. And more than that, I think it's quite clear that the top-tier corporates, who should be the issuers coming to market, the best credit rating, etc., have the least incentive often to do so, because they're very well served by banks and don't necessarily see the advantage of coming to market. So creating more corporate issuers over time, I think, will be one of our key priorities. And the second point, quickly, I think we talked at the beginning of GEMRA and ISTA, etc. I think money markets is another topic that I believe is a bit underappreciated. The importance of money markets, liquid floating rate benchmarks, etc., I think is the fundamental of capital markets, and maybe could be emphasized even more, because I think it ultimately is what allows this system to provide maturity transformation.
Very good, thank you. Unfortunately, just checking the time, we've unfortunately run out of time on this panel. I certainly could go on for another hour or so. But as Jeff mentioned, I mean, this report is very much the starting point for many of the discussions we hope to have over the next year with as many of the countries in the index as possible, and hopefully all of you here and those tuning in virtually as well. But yeah, that just gives me time to just thank Michael, Yamungu, Zafara, and Martin for your insights, and Catherine we just heard of as well. Thank you very much. Just give a round of applause for our panelists, please. And yeah, so with that, I think relatively optimistic tone that there's going to be more innovations, but as Martin mentioned, still work to be done in some areas. I'll hand over to Charles Rousson to give the final words, the interim CEO for Absa Group. Thank you.
Good morning, ladies and gentlemen, distinguished guests. I'd like to first just thank the panelists first for not only giving of your time, but what I thought was a very informative discussion, and certainly gives a certain level of, I'd describe perhaps cautious optimism as we go forward. I'd also like to say on the 8th anniversary of this, David, to you and your OMFIF team, a massive thank you. I think we certainly view it as a partnership. We find you're a fantastic partner in this, and almost view you as like an extension of the family, so thank you. I'll keep this reasonably short, but there's a couple of points I would like to lift out. You know, I think what we heard here this morning are there's significant possibilities when policies open the doors for African businesses that enable them to reach global markets. The continent is of strategic significance as a partner in advancing the global priorities, not only because of the abundant natural resources, but also due to the growing economic potential, demographic trends, and geopolitical significance. Much of the economic engagement has traditionally been focused on poverty reduction, foreign aid, and addressing conflict and insecurity. While critically important, all of these are, these priorities have not fully kept pace with the dramatic changes occurring across the region as Africa today has emerged as a premier destination for innovation and inspiring entrepreneurs amongst other investment opportunities. If we take anything away from this morning, it is that there is consistent progress across the continent. This is evident in the Absa Africa Financial Markets Index, as we've just heard. In measuring the accessibility, transparency, and openness of financial markets across 29 African countries, the index shows that overall scores rose in 82% of them, the highest share since the index inception in 2017, a very encouraging sign. More favorable global financial conditions have boosted activity in securities markets, increased the value of pension fund assets, and improved FX reserve adequacy in some markets. Macroeconomic conditions have also strengthened, with inflation easing across much of the continent alongside structural improvements in market infrastructure. Transparency has improved in FX markets, monetary policy decisions, and corporate creditworthiness, while legal frameworks are advancing across the continent. ESG principles are being better integrated into the financial systems in 23 of the AFMI countries, supported by new sustainability-linked issuances designed to appeal to future-focused investors. It's clear that the widespread and long-term progress to develop financial markets, despite the global shocks experienced in recent years, bodes well for Africa's resilience and investment prospects. I would like to reflect on the potential around Africa's small to medium-sized enterprises, those that keep their cash under the mattress, which are a powerful investment entry opportunity. SMEs represent over 90% of the registered businesses in sub-Saharan Africa and contribute approximately 50% to the region's total GDP, playing a pivotal role in driving inclusive socio-economic development and growth across the continent. But they need support. Many face limited access to finance, inadequate infrastructure, complex regulatory environments, and a lack of resources and skills, making it difficult to scale effectively and to compete in both local and global markets. That's why Absa's commitment to Your Story Matters is reflected in our support for initiatives that drive growth and financial inclusion, with a focus on SMMEs led by women and youth. Through programs like Absa Emerging Entrepreneur and Absa Business She Thrives, we offer tailored solutions designed to empower these businesses and to help them succeed. But more needs to be done. It was encouraging to see just last year, the US facilitated 547 new two-way trade and investment deals in Africa, totaling in excess of $14 billion, a 60% increase in both number and value compared to 2022. So in closing, we believe that the systemic progress to the development of financial markets, even in the face of challenging macroeconomic conditions at these times, bodes well for Africa's resilience and investment opportunities. I'd like to thank you for joining us this morning and enjoy the rest of your day. Thank you very much.